Good afternoon, everybody. We have about 11 participants here, and I believe that because of our time, we can
Good afternoon, everyone. We decided to just wait a few more minutes for more people to join. But I think we should start so we don't keep those who have joined waiting. And so that people know that once women in finance says 1 o'clock is 1 o'clock. So I do apologize for the delay. I hope everyone can hear me. So can you all hear me? Hello?
Yes, I'm hearing you.
Okay, thank you. I just wanted that confirmation. Okay, so thank you everyone for coming to this webinar. Today's education is the education committee that organized this, and we normally have these seminars and webinars to educate our women on various topics. I think we've done almost a dozen so far, but today we have the presence of Miss Titi Odunfa Adeoye that will teach us on, do a keynote session on US equities. As you know, Nigeria, the economy is tough at the moment. We need to all increase our ability to earn income and, of course, progress in our careers. And I feel that we would all benefit today from listening to our keynote speaker. I also want to use this opportunity to welcome those members of the Women in Finance group. This group was set up or founded by Dr. Toyin Sani, our chairperson, and the objective is really to progress careers of women in finance, encourage more women to go into the financial career, increase knowledge, and network amongst themselves. And I believe that we have been able to do that. I also want to just mention dear Commission Chair for the Gender Commission, Dr. Ola Brown. I don't know if I've heard, let me see. Yes, she too has been very instrumental in getting our keynote speaker and also organizing this webinar. So I want to thank all of you for this, and I hope that you will have an engaging session. So with that said, I would hand over to Abisola to introduce our guest speaker. I don't see Dr. Ola Brown on the call.
I'm here, ma'am.
Oh, yeah, okay. Yes, I noticed that Abisola sent this link. Once you use it to join, the name that comes up is her name. So yes, maybe you should just do rename. I mean, so that your name comes up. Okay. So Dr. Ola Brown, please introduce our keynote speaker. Thank you. Welcome, everyone.
Our keynote speaker today, I'm super excited about. She's a great friend of mine and informally one of the best wealth managers that I know. Formally, her name is Titi, and she's the founder and CEO, managing director of Sankore Investments, which is a multi-asset class investor that invests wealth on behalf of institutions, families, and high net worth individuals across different asset classes, including US public equities. She, before founding Sankore, she worked for Zenith Capital, which is a capital management arm of Nigeria's most profitable bank. And before that, she worked for Goldman Sachs. And even before that, she completed her master's degree at the prestigious Harvard Business School. So it's really my great pleasure to welcome my friend and somebody that I really respect her work to teach us all about our diversification strategy and US equities. Thank you.
Thank you so much, Ola, and thanks for having me. So should I just I guess I could just start? It's a very small room. Thank you so much. It's a small room, so I'm hoping we can have somewhat of an engaged session. So I'm going to share my screen. I'm going to try to not make this too much of a PowerPoint type of presentation. And since it's small, I don't know what you guys think, Ola, but I don't know if it'll be okay if people can ask questions or participate. If there's anything that they want to ask, maybe just sort of indicate, and then we can just sort of try to make it a bit more interactive.
Fantastic.
Awesome. Okay, good. So sharing my screen, please give me a second, and we will get started here. Okay. So first, I think before, thanks for that introduction, Ola. It's a great pleasure to be here. Thanks for the invitation. I think before starting, I wanted to have a little bit of a sense of the audience so that I also just sort of have a sense of just sort of how to tailor the keynote. So I was wondering if I could just have, by a show of hands, an indication of people who already invest in US equities. Do you feel like you're already someone who has a little bit of experience in it, whether it's a lot of experience or just a little bit? Can I just see a show of hands? And I think you could just show via, okay, I have a few there. Okay. So, I mean, overall, we have a couple of people in the room who are already sort of experienced in this asset class. That's good. Maybe I could just sort of occasionally ask them, to help us think about a few areas or, just sort of shed light on their own investment strategy. But overall, what I want to talk about today, Sankore is very much a macro investment platform. What that means is everything we do, we start out by trying to understand just sort of what's going on in the world. We also even do that all the way back to looking at world history, down to, of course, trying to understand what's going on now. But I think the first thing I would want us to be very aware of is, unlike, saving your money in a bank or putting your money in fixed income, equities do require you to have a longer range of just sort of thinking, a longer range of risk tolerance, and just being able to think beyond just this year. And so because of that, those of us who spend a lot of time doing this professionally, it is very important for us to have just sort of a broad view of what's going on in the world. And interestingly enough, I think it's not just the professionals that should do that. I always encourage anyone who has any sort of investment strategy to definitely just sort of try to be somewhat educated about, the asset class that they are investing in. And so I will just sort of try to set a stage for just sort of what's going on in the world right now and see if we can use that to just sort of help us, when we get to the investment strategy section, help us think through what this means, right, for our portfolios. Then, this is actually not a webinar focused on the equity asset class, it's actually on US equities. And so I want to speak very quickly about why US equities are so interesting to so many people. And then we'll just talk about briefly a few investment themes. And then we can just, I'll try my best to go very quickly through a lot of these initial slides, and then we can just then maybe try and spend some time on the investment strategy then. So just setting the stage, as we mentioned, Sankore is an investment firm and we work directly with institutions as well as individuals. And one of the things that we do is we try to give them advice about what to do at this current time, based off of the results and the work that we have done, just sort of looking at the macroeconomic environment. Right. And so I want us to just be aware of where we are now. This is 2024. We're still in a period where many people consider us to be post-pandemic. Even though the pandemic was in 2020, which is many years ago at this point, it's important for us to realize that many of what we're going through right now are still a direct result of the pandemic. So if we all remember, in the year of the pandemic, you actually saw a sharp drop in asset prices globally. U.S. equities being one of them. Equities generally, most risk assets saw a sharp drop, but then the beginnings of a really strong rally. We'll talk about this a bit more later, but it's important for us to be aware of the fact that what we're seeing right now in equities is a result of what started then. Post-pandemic, you had economies, just sort of central banks around the world just sort of start trying to, you know, sort of provide a panacea for their economies, right? So, you know, we saw just sort of strong easing, and by easing, I'm sure many of you are familiar with that, what that means, but across the world, central banks started to cut interest rates. Now, interest rates being cut just means greater liquidity, greater availability of cash, right? And so there was really money everywhere. Central banks, especially the US Fed, tends to just sort of have a very strong leadership position in the world. Also started to buy up assets, financial assets as well, which of course will cause these assets to rise. So you know, just sort of starting in 2021, one of the things that we were starting to speak to clients about is the importance of buying real assets. So at that time, we didn't think it was a good time to buy global equities or US equities, really any equities at that time, because for us, we actually really felt that it was not a fundamental rally. And this was a viewpoint we kept all the way through 2022, and really encourage our clients to stay liquid and stay real, which means just sort of stay in fixed income. And fixed income did very well during that time because, again, rates were dropping. And then you had just sort of increasing prices. Everyone is aware that as yields drop, prices of fixed income instruments will go up. So it actually made more sense for us to be in fixed income, we felt at the time. However, at the beginning of 2023, remember 2022 led to now a sharp correction. The central banks went too far, right? They all just sort of flooded the world with money, zero interest rates everywhere, led to, I'm sure we all remember just sort of the period in 2021 where people were buying meme stocks, right? Think about why that was happening. It's especially starting with a place like the US where, you know, people were working from home, people had freezes on their rent, they just had a ton of money. And time, and that led to just sort of some level of extreme behavior. It's important for us to just be aware that these sort of things do happen in markets from time to time. That extreme behavior led to the crash in equity prices of 2022. Now I would say it was more of just sort of a recovery back to normal. So it wasn't an extremely large crash, but it was a good time for us to just sort of come back to normal. And given that 2023 for us was a period where it made sense to then start going back into US equities. And we were very aggressive at that time about speaking to our clients about this being the time. It's a good time now to just sort of have a long-term strategy. Now, remember, and we'll talk about this later, but remember, market timing is not generally a good idea. But when you are about to start your allocation, it is a good time to think, hey, is this the best time to put all my eggs in this asset class or not? And that's generally, given that we're speaking to people who, at least based on our poll at the beginning, many of you haven't yet started your US equity strategy, it's good for us to now start thinking through, okay, is this a good time or not? And we really felt that the beginning of 2023 was a very good time to have a long-term strategy and allocate to US equities. It was quite a contrarian view at the time because there were still fears around a potential recession, but it did turn out to be prescient. So where are we now? We're now really at a time where we still believe that there's a lot of value in US equities for investors who just sort of have a long horizon. Remember, equities don't really make sense for you if you're looking to make money to pay rent this year. So definitely, this is a very interesting time that we believe you should be looking at US equities, along with, you know, a few other asset classes as well. So just to step back, back to this idea of us understanding where we are and just sort of what's going on with the global macroeconomic environment. We always at least like to look back at least 1 year. I've already taken us back 4 years at this point, but just to now focus and go in a bit deeper. For us, we are very much a thematic investor, which means, as I said, we like to understand just sort of, we like to create a framework that help us to look at the world and look at financial markets. And in 2023, for us, we were really trying to understand just sort of a few of these key areas that we feel drive investment returns generally. Geopolitical tensions was one that really we kept a strong eye on and are still keeping a strong eye on in 2024. Just to make this a bit more relatable for everyone, to the topic. The reason some of these themes kind of help you with your investment strategy is when you have a very clear theme, you can actually come up with investment ideas that are based off of a theme, right? So for example, if you know that geopolitical tensions will continue to run high for a period of time, you may, especially geopolitical tensions around the Middle East, you may then want to think about, oh, well, is this going to affect things like the price of commodities, price of oil? Is that potentially going to affect the profitability of energy companies? Those are all the sort of things that help you actually come up with the strategy. And the more you know about just sort of the way the world is working, the easier it is for you to be confident about your investment strategy. So that's why these themes are important. So either way, for us in 2023, we were looking at just sort of, the broad geopolitical tensions across the world. We were looking at just sort of the potential of a post-pandemic global slowdown. US versus China has been a theme for us for many years at this point, almost a decade. And we continue to keep our eye on it because it has large impacts on many areas. As you know, US versus China has many different elements, just sort of trade wars, but there's also just this disagreement around Taiwan. Taiwan has become a very important country now in the rise of AI, given their focus on semiconductors. So all these things do trickle down to your investment strategy. The regulation of tech is also a theme that we're keeping our eye on because that has potential to affect just sort of how tech companies do in just sort of the sort of revenues that they generate. I'm sure many of you have been following just sort of a lot of the pushback against the rising power of many of the tech giants, some by parents, some by governments that are just sort of trying to curtail their power. These things have a potential of impacting just sort of how these companies do in the future. And another thing we're looking at in 2023 was just sort of China's reopening. I'm going to skip a lot of these because I've kind of talked about it, just sort of this idea of what was going on in 2023. But at least some of the areas I want to focus on that I mentioned, if you see here, this sort of shows you what happened to global markets in 2023, right? So based on what I talked about with regards to us moving into the post the easing cycle, the fact that at the beginning of 2022, central banks now started to increase interest rates in order to fight inflation, which of course happened based on just the cash everywhere from the pandemic. You can see here just sort of how large the increase in key rates were in 2023. And based on that, you can see what was happening also with bonds and the fact that yields really started to tighten in 2023. All these things are important for you to just sort of, have a sense of how, the things that central banks and so on do affect the markets. Next, of course, is just sort of what happened to equities in 2023. This sort of shows you that in line with our expectations, we did see a recovery from 2022. And one of the things that also happened in 2022 that was really important was the launch of ChatGPT in November 2022. That really led to quite a lot of excitement around artificial intelligence, and artificial intelligence did become one of the subsectors of the markets that really had a strong showing in 2023. So you can see across the world, in both local currency and USD, there were quite strong performances in equity markets. S&P 500 was up 25% in 2023, much higher than expectations at that time. And so 2023 really was a really good year for markets. Just sort of this makes sense given where we're coming from. Of course, given what was going on with just post the war, during the war, we had actually seen commodity prices go up. Commodities are very volatile, but in 2023, they sort of started to come down from the highs of 2022. One area I do want to speak about very briefly is cryptocurrencies and Bitcoin. We actually began coverage, official coverage of Bitcoin in July of 2020, and for the first time recommended for our clients to start to consider a long-term allocation to Bitcoin, not a trading allocation, but a long-term allocation. Now, the reason this is also relevant to this conversation is we're starting to see the beginnings of institutional money coming into Bitcoin, and Bitcoin is starting to gain acceptance as an asset class. And so in 2023, it was also one of the top performers in the year. We'll talk about it a bit more later, but I did want to show this very quickly. The fact that there are now ETFs for retail to be able to invest in Bitcoin is actually something that's relevant that you want to keep in the back of your mind. So overall, I think the last thing I wanted to mention is, of course, just sort of the dip in venture capital funding, that we really started to see take off in 2022. This has some relevance to just sort of the future. But one of the things that I do want to point out is even though this is starting to recover, because it really was at a point that was a bit unsustainable, and we're starting to see a correction. AI funding is an area that we're seeing quite a big takeoff in. And this, of course, has impact with regards to, just sort of our investment strategy for the future, how to invest in technologies like this that we hear about. How do you get exposure to things like the Bitcoin economy and AI economy? So overall, we've talked about 2023, 2024 now for us, how we see this year vis-a-vis where we've been and where we believe we're going. Some of the areas that we're really just spending our time to keep an eye on, and again, we don't change themes every year, but there are certain things that we do change. As you can see, there's some themes that continue this year. We continue to keep an eye on geopolitical tension, and we're already starting to see some tension in Africa. Now, all of these things are things that even affect, just sort of how you should be thinking of your funds, how you should be thinking about your split between Naira and USD. All these things have some impact. Higher for longer for us is a big theme this year. Just based on the fact that we've actually been talking about this since 2023, that we don't believe that we're going to go back to pre-pandemic interest rate levels. That has a lot of impact on a country like Nigeria, where we live. If, for example, and now remember, now we're not saying that we don't expect for the Fed to cut. We really do think that the Fed will begin cutting sometime this year. But it is our belief that we are not going to see, just sort of the levels return back to where they were pre-pandemic. And that has significant impact, especially to emerging and frontier market countries like Nigeria. One of the problems that we're currently experiencing right now just sort of FX instability is actually also exacerbated by this high interest rate environment. In the previous times where CBN has had to try to solve this problem, they've typically issued a Eurobond. They've been very slow to do that because interest rates are currently still so high. They're starting to come down, so it's likely we will see a Eurobond issue sometime soon. But keep in mind that higher for longer now means our borrowing costs in countries like Nigeria are going to be much higher, which is going to make it harder for the government to defend the Naira. Higher for longer has impact on just sort of your fixed income investments as well. It has impact on your interest in US equities as well. What should your allocation to equities be if you can already get risk-free for just so much higher? China regulation of tech, we talked about. This is something we continue to look at because we want to be very clear. How are all of these things going on? How are the lawsuits against tech giants like Meta and Google going to affect their profitability going into the future? All of the calls for just more accountability for impact on children, impact on businesses. All of these things are things that we have to keep an eye on, just based on just how large tech has become as part of the overall market. China continues to be an area we continue to watch. The US versus China theme for us has evolved into a theme around China's maturity. And for us, we're now starting to see a new theme come up called global fragmentation that is also, as you know, a part of the blowback of the US versus China. As China matures, it actually has some impact on the world. It has impact on inflation globally. It has impact on other countries becoming part of the complex for, you know, just sort of manufacturing cheap goods for Western countries. All of these things help us even think about just sort of other countries that we may want to invest in. As China matures, there's certain countries that become much more interesting. And for us, even though we invest in primarily US equities, we also have an allocation to global emerging markets as well as developed markets. As China matures, countries like Taiwan and Mexico become particularly attractive because they're going to be some of the ones that just sort of benefit from China's increasing maturity. Sorry, Mexico and Vietnam, not Taiwan. So these countries become the sort of countries you want to, you know, keep an eye on and say, hey, maybe I want to buy an ETF, give me exposure to Mexico, give me exposure to Vietnam. These are the kind of countries you want to also be looking at. Global fragmentation, I mentioned that our US versus China theme has evolved. Global fragmentation is now broader than US versus China. It's us being aware that the world is increasingly becoming balkanized, where everyone is disagreeing. Political situations in especially a country like the US. And the reason we spend so much time looking at the US is because, you know, when the US sneezes, the rest of the world catches a cold. They are still by far the dominant economic leader of the world. So a lot of the things that they do have impact on everyone else. So looking at just sort of their political landscape, what's going on, looking at what's happening in Europe, we're already starting to see that there's a lot going on around the world that's going to affect financial markets. We're effectively seeing much less globalization. The peak of globalization was, just was probably, we've probably passed it now by probably 7 to 8 years or so. We're now starting to see a deglobalization that is leading to countries now starting to shrink the amount of work they send to places like China, and onshoring is becoming a thing. People are bringing manufacturing back into their own countries, or also just using countries close by. The US is doubling down on a place like Mexico to meet its needs, and not just relying on China. So this idea of just the world increasingly becoming more fragmented has impacts on financial markets. And these are all things that, affect just how we think about our investment strategy. I've talked about a lot of this. This chart just sort of shows you what happened with CPI and how bad it was, and, just sort of how interest rates responded in results. But I will try and skip this just for the sake of time, and just sort of have us now focus a bit more on why US equities. So this is an interesting quote that Larry Summers made several years ago, where he said, Europe is a museum, Japan's a nursing home, and China's a jail. And he said this, just sort of in response to people asking, okay, why, for example, does he think that the US, I think there was some question about, his optimism around the US, right? And this was his response. Now, this is an extreme way to look at it, but we still believe that the US is still the world's dominant force of wealth creation. It is still the largest economy. That's increasingly, of course, China is definitely catching up really quickly. But the dominance of the US is not just based on size. Right now, the US is still the center of global innovation by far. It is still the place where much of the value of new thinking, still comes out of the U.S. And this is, a structure that has been built over quite a long time, and it's not something that we see, we don't see that being challenged that quickly. Of course, you're starting to see what could lead to it being challenged. You already see in the second chart, China's already doubling down on just sort of innovation, and patent applications are already starting to increase and so on. But it still takes a while, and we expect, at least within the next decade, for there still not be much of a challenge to the United States dominance. Because again, the cycle of discovery to actual value production really does still take some time. And one of the key things that the US has done to make itself the center of innovation is being able to be attractive to the world, which then, just sort of attracts the best minds, which then create value from, many of these discoveries. China is still very far away from that, even with regards to immigration policy, but also specifically with soft power. You'd be surprised how much of the US's investment in, just sort of its culture, investment in places like Hollywood, have some impact on its ability to attract the best students to the country. So we still look at the US as just being the center of global innovation. US productivity is also something that we expect to just sort of stay quite dominant. I mean, you can see just sort of the chart on the right showing labor productivity growth. The US dollar is still the dominant global currency. We are definitely of the belief that that's going to change in the probably closer than many people believe. But as of now, 60% of all known central bank reserves may be as low as maybe 58 or so, but it's still, it's still the dominant reserve currency, right? And that there is just still such a benefit to reserve status. Reserve status really does allow you to have significant control of the world's economic environment. And so that continues to give countries benefit for at least the next several business cycles, which is what you care about for your equity investment strategy. So we don't expect this to change anytime soon. The US consumer is still extremely strong. Household balance sheets are really large. And so we're at a point where, when you have the choice of where you could invest, where you could put your money, the US is just dominant. We invest, as I mentioned, in global equities, but even our global equity fund is extremely US equity dominant for the reasons that I've mentioned. And so we definitely look at other countries, but there is a reason that the US does take quite a lot of our effort and focus. It is really still the place where the greatest value is created. And valuations, are stretched at this point. But it's one where we have seen just sort of multiple expansion and valuation increase during, the previous easing cycle. Now, it still remains to be seen whether these kind of valuations can be maintained as things just during this period of just higher for longer. But we're of the belief that, a very careful and well-structured equity strategy would be one that would still generate quite a lot of value long-term, and allow you to just sort of also protect against valuation issues. But we definitely do believe that, historical valuations are going to be higher than future valuations are going to be higher than historical valuations. And that's already just sort of been something that we've seen. So again, back to just sort of why we've talked about just sort of the dominance of the US and, just going into, and that's just more of a macro view, but just going into, the rest of just sort of why it's important, right over this current business cycle, the monetary policy is accommodative at this point. We're expecting rate cuts to start, and that's really going to just trigger more reallocation of assets to equities. All of the people who have taken their money out and are sitting in short duration in fixed income instruments are going to start to look for higher returns, and they're going to start to reallocate assets back to equities. There's quite a lot of cash sitting on the sidelines waiting for the right time to come in. We've talked about just sort of the resilience of the US economy in this cycle. The job market has continued to be very resilient. The US economy overall has continued to be quite strong. Corporate earnings are also looking really strong, especially because of just sort of what has happened over the last few years. Corporates have really spent a lot of time, just sort of tweaking their cost basis. So they're going in likely on lower operational costs. Borrowing costs are a bit higher. So because of that, you will actually see likely, people gravitating towards the large caps over the mid caps and the smaller caps because they're a lot more sensitive to borrowing costs. But as borrowing costs come down, then, you then have the likelihood of being able to just sort of see, increases in mid caps and small caps. So again, I think I'll skip this and just let us, because we don't have that much time left. So I'll just kind of have us just talk specifically about an investment strategy. So I was thinking I would love to hear from someone, anyone really, just sort of how they think about their investment strategy. Just a one-sentence answer, really. Is there anyone who would like to share? I don't want to cold call anyone, but if there's anyone who'd like to share their own investment strategy, I think that'd be helpful.
Hi, I can share.
Please.
So it changes from cycle to cycle, but right now I'm, allocating increasing amounts to fixed income,
Okay.
just because the interest rates are high. a bit lower on the real estate front because I feel like there's already a strain on real estate, especially US real estate, because of the mortgage rates, and people are less likely to buy. So I've come down on real estate a bit. But I'm always bullish on the future. And I think, you know, when you're in your sort of 20s, 30s, having a longer term perspective works. So I also have a smaller allocation to venture. My public equities, both in Nigeria, I've kind of come down on the Nigeria side, but I still need Nigerian income. So I love banking stocks in Nigeria right now. So I would say currently I'm sort of like 60% fixed income, which is rare for me, but this is a rare environment and we might not see this for another 10 years. And then the rest is allocated between venture, public equities in Nigeria and in America and real estate.
Fantastic. Awesome. That was very like detailed. I love that. I can see that. I can see I'm speaking to an investment guru. So I think that really helps us think about just sort of how you should be thinking about your investments with intention, you know. Because of time, I think I'm going to skip the themes, right? And then I will just talk more about investment strategy. I think we only really have about 10 minutes left, right? And we can share some of this later, but some of this stuff I think we can hit. I wanted to talk about especially because I actually really love speaking to women groups, because I think women groups are very interesting when it comes to just sort of how we think about wealth creation. I do like to talk about the wealth gap. I talk about the wealth gap more than the income gap because the wealth gap is actually bigger. The wealth gap is 4 times the size of the income gap. This is a quick one. Just it's not like there are that many statistics on it, but and not that, you know, billionaires are the way you would measure the wealth gap, but this is at least a quick statistics that helps us see that there is a huge difference in how the level to which women accumulate wealth versus men, and just sort of what we tend to focus on. This is, as I said, just an extreme example, but even with everyday people, you know, just the amount of wealth that women are able to gather tends to be much smaller than the amount of wealth that men are able to gather. And it is not for any fundamental reason. There actually is some scientific evidence that women, when we invest, we actually have better outcomes than men. What I find is most women don't know that. And most women tend to think that men are better investors than they are. It is something that I find important to just ensure that women gain more confidence about our ability to make investment decisions. So, and question is why? Like, why is it that we gather such, you know, just a smaller amount of wealth? And, you know, of course, we do know, you know, generally, you know, the average woman is probably more likely to focus more on family building than maybe building wealth. So maybe that's what causes that. But of course, within this group, that is probably not the primary reason. So maybe for the average woman, it is things like, you know, joint assets from marriage are often not in both names, fewer pensions due to part-time work because you're taking time off to take care of kids. You're more likely to be artisans than entrepreneurs. And remember, there's actually a difference between artisan startups versus, you know, building a business that is entrepreneurial. So if you have like a company that makes cakes, that is actually artisan entrepreneurship rather than, you know, the sort of entrepreneurship that can build great wealth. Not to say you cannot make a lot of money from cakes, but those do tend to be sort of more lifestyle type businesses. So now to speak to the people in this room who are not the average woman, these two are probably the things that affect us the most. These 2 points on the right, we're more likely to save and less likely to invest. That means that, yes, women, we put money away, but we put it away safe and we put more in fixed income than men do. We're more likely to be worried about losing money rather than making money. And then we're less likely to use risk to good advantage. And by risk, I mean, again, back to investing in risky assets. Risky assets move up and down a lot, but at least the right asset classes tend to move up, right? So those are the things that we need to know, that as women, we have these predilections. But remember that if we own these predilections, right, our attention to risk actually helps us make more money if we, just sort of do it right? So just remember, our attention to risk actually helps us in the long term. But we then have to say to ourselves, okay, it's really about, and for me, working with women, I've realized it's really about us just knowing what it is that we're investing in. When we know about the space that we're going into, we are likely to build a portfolio that is stronger than portfolios built by our male counterparts. And so what I try to do is just have everyone be really, really clear. Like, why? Why, for example, do you need to invest in equities, right? It's important that you build your portfolio in this order. Your fixed income is your sleep well money, your real estate is your portfolio perennial, your equities are your growth engine. And that really is why you want to make sure that you do have equities, because that's actually what causes it to grow. Then you have other things like your commodities, VC and crypto, and gold. And so you do need equities in your portfolio. We actually tend to think that equities in Nigeria are, long-term just a bit risky. The U.S. equities do tend to give you more return. So now that we know that equities are important and we need to learn about these equities, how do we then go about learning about these equities? And so I suggest for everyone to start thinking and learning and thinking thematically. So I'm going to take you very quickly through a few themes. As I said, when women know and understand what they're investing in, we do extremely well, slightly better than our male counterparts. And so thematic investing for us is the way to just sort of solve, the way to really make sure that you are understanding what you're investing in when you don't have a lot of time. I mean, this is not what you do. Excuse me for the slides jumping around. This is not what you do on a day-to-day basis. So it can be hard to do single security analysis. You don't have time to, just sort of, pull the financial statements of NVIDIA and be jumping onto their calls. But all of you can actually invest thematically. Investing thematically helps you know just sort of, okay, this is what I'm investing in. This is why I'm investing in it. And I'm just going to invest in it over the long term and take a broad allocation to that theme. So I wanted to talk to you about 3 themes that we like right now and we are looking at. And it helps you just think about why it can be very easy for you without you doing single stock analysis to start investing thematically. I'm going to talk about a basic theme that maybe we all can relate to, given that nowadays everyone really, is on social media, right? So we all maybe have Instagram accounts, WhatsApp, we all use WhatsApp. We all, a lot of people have Facebook or used to have Facebook. So point is, it is easy enough for us to try to understand what's going on with these companies, right? We can try and think about it. So one thing for us to be aware of is many of these companies are not, even though they're social media companies, what they really are is they sell advertising, right? I'm sure we all know that, that Meta and Google make most of their revenue from advertising revenue. So that means really they're like in the advertising industry. They are, trying to attract our eyes in order for them to sell advertising to corporates and agencies, right? Now, because such a large portion of the tech companies are actually in advertising. It was interesting for us to then look at advertising as a theme and try to understand what was going on with advertising. And so you can see on the first chart on the left, we took a look at just sort of the evolution of ad spend, right, over the last few decades. And to be honest, ad spend continues to go up. Just like corporate earnings go up, people spend more on advertising. And remember, in a place like the US that is not at the level that we are at, much of their goods are not necessarily meant to provide the basics, even though lots of things provide the basics. I mean, you have your consumer staples, but a country like that is also pushing a lot of products that on your Maslow's hierarchy of needs are not about basic survival or eating or sleeping. They're about self-actualization and reflecting yourself. And so things like fashion, whether you want to drink a certain type of coffee, whether the coffee you want is the one where they donate to orphans, like in the US, much of the products now being sold are not basic. So they have to have an angle. And so advertising spend is going to increase because they have to be able to push their product to people. So because of that, advertising should remain strong in economies like the US. It's not the same in Nigeria, remember that. And it tells you why, companies that are trying to do much of what, Meta and Google are doing in Nigeria, it doesn't make sense to do that now. But in a country like the US, definitely ad revenue should continue to be very, very robust, just as corporates are robust. Now, question is, what's going on with ad revenue? And what should we expect to happen? What we're now starting to see with ad revenue is that it's changing. So you can see with the chart on the left that pretty much with the advent of social media, I remember opening my Facebook account in 2005 when it was still just schools. You can see pretty much that's when newspaper advertising started to drop, right? People just really don't get, I mean, I think there's still some old people who do, but not that many people read newspapers anymore. I still occasionally look at Business Day, but I'm also not, I'm in my 40s, so that's probably why I do that. The key point being that is likely an area that will continue to drop, newspaper, television, and you're seeing increases in search, online video, social media. This is where advertising spend is going, and it continues to grow. So this tells you why those companies are making so much money, right? This is stuff that's easy for us to understand. You don't have to download Google's financials to figure out, okay, does it make sense to invest in Google? You can actually go a bit more macro, right? Which women tend to be very good at, just sort of aggregating many different areas of information. You can listen to podcasts about the industry, and you can see from this very basic chart that advertising, the types of advertising are changing. People are moving towards all these tech companies. So that's already one thing that tells you, okay, companies like Meta and Google are probably set up to do really well in this new world. Question is, how long will that strong growth continue? The next thing to think about in advertising, which we looked at, is just sort of what is going on with just sort of the people that make money from digital advertising. Remember, we've already, first of all, said that digital advertising looks to be the winner, right? So if digital advertising is the winner, who are going to be the winners within digital advertising? Well, what we're seeing is, even though the pie of digital advertising is getting bigger, guess what? The players are also, back to this fragmentation theme we had at the beginning, it's also becoming much more fragmented. So back in 2016, where you saw actually Google being about 31% of the pie, back to now, Google is only 27% of the pie, and there are many, many more players coming in. So what's actually happening now is the world is literally just being aware that, look, advertising is likely going to move. Eyes are going to move towards these digital platforms. You see in the previous chart, TV is dropping and online video is going up. Well, guess what? Companies like Netflix are actually going to take us back to how TV was, because Netflix has now launched an ad supported tier. So now you will be able to watch Netflix without paying if you watch the ads, right? And there will be actually people who take advantage of that. So what that means is that in 2024 and on, you're going to see many, many more tech companies selling ads. Between 2016 and 2023, as you can see, Amazon was 1% of advertising. Amazon is now 7% of digital advertising. And that is a really powerful revenue set for Amazon, because they sell products. If you advertise where you sell products, it's even stronger, and they have a bigger case to gain more of that advertising pie. So that already also shows you, wow, potential winners in this space could easily be Amazon, Google, Facebook. You're already starting to see, wow, these are the big dogs who are likely to just sort of dominate this space, even as it continues to grow. So that's how a theme works. A theme works where, you can stay at the high level. Many of the people on this call are executives. You don't have time to do analyst work, but you can come and try to understand industries and themes. And that really helps you know and be confident in what you're putting your money in. By doing this exercise, you'll probably be a lot more confident if I said, hey, buy a basket of Facebook, Google, Amazon, and don't touch it for 5 years, right? Because of the trends in digital advertising, the trends in just sort of how things are moving within the space of digital advertising itself. Just know that it will be volatile, because again, tech companies do tend to be volatile. But when you know more about something, you do become much more confident to be able to ride through the volatility. And I think that that's definitely what works for people at this level to do with your investment strategy. So for us, that theme, for example, now leads to us being able to say, look, we like these companies, right? Based on what's going on in that space, there's some companies that we like and some companies that we don't, right? We really, really like companies like Microsoft and Apple that are not direct players in advertising, but provide ongoing support for all of the tech companies and all of the digital infrastructure. They will actually be fine regardless of what happens, but they continue to benefit actually because they provide much of the structure, hardware being Apple. That's how we consume all these ads, right? So they're kind of the, in the gold rush, the people that sell the shovels, that's Microsoft and Apple. They are perennials for us, and we really believe that they will just sort of continue to be dominant players that we can invest in and just close our eyes. Microsoft being on the software side, Apple being on the hardware side. And then Google and also Meta for us are just sort of the players that we think will dominate in the ad space, even as it grows and still becomes much more cannibalized. Companies like Netflix, we think will, do well, but they're just seeing too much competition. It's likely that, they will just, what they're doing may become quite commoditized if they don't do anything to just sort of differentiate themselves. They're trying to do it right now with original content, but so are all the other platforms as well. And we think that the more platforms that come in and everyone's looking for content, it means that it's going to make content itself the valuable bit and make the platforms that provide content less valuable. So even though they're offering ads and so on, we really do not think that they will win in that game. And then, you have old guard companies like Yelp that we think are definitely going to have a hard time and really struggle with ad revenue going forward. So that means, you kind of now see, okay, who are going to be the winners, who are going to be the losers. You can invest in the winners. You could also invest in the winners and short the losers. Those are some of the things that you can do if you really want a bit of a bold strategy. Depends on how themes can make you really feel confident. And I think that's what I'm trying to get across here. So these two other themes, I won't spend too much time talking about it, but we really like the blockchain economy. We like what's going on there in the long run. We really think because of how volatile it is, one should only have a teeny tiny bit and just assume that you're buying just a few Bitcoin for your child's first house, something like that. Because I'm assuming people on this call maybe have, relatively young children. So just think of it as something you're not going to touch for 10 years and close your eyes. But it's not something you should put a lot of money in. But we really do like this asset class. We think that we actually do believe it's an asset class. And we've done a previous call on it in the past, trying to explain why. But let's all be aware that the form of money has changed many times in human history. We've done cowrie shells, we've done pieces of paper, we've done coins, we've done gold, we've done all sorts. Digital money is really the next place that makes sense. And we do think that that will likely happen at some point. So artificial intelligence, and that's the last theme I wanted to talk about. It's important for us to be aware of just, the dominance of AI as a theme in the markets these days. I can't overstate just sort of the importance of it. It's not a new technology, but it's important for us to realize that just sort of OpenAI did catalyze something, and it made it such that we're probably moving away from this idea of an interesting technology to solutions, right? And that is actually something that we think over the next decade, there will be quite a lot of dominance there. Question though is how to invest. Like, how do you get exposure to AI? Where should you invest within the industry? Does it make sense to go and buy NVIDIA at these levels? For us, we are believers in the fact that look, things can get a bit extreme where, bubbles can form. We are at a point now where, we were definitely exposed to NVIDIA up till maybe a month ago. And for us, we're now at a point where we're starting to think that things maybe have been just sort of have run up too far too fast. We may be waiting for better levels, but guess what? There are easier ways to play AI that, you don't have to worry about buying companies at valuations like NVIDIA. Exposure to Microsoft is a really great way to play AI. Again, given the fact that they are actually shareholders in OpenAI and many other reasons, just the fact that they play they're dominant in enterprise, and enterprise is going to be one of the top demand sectors for AI. So this is another theme that it's worth learning about. And I would suggest, just sort of listening to podcasts is an easy way while you're on the treadmill, while you're doing anything. It's easy to actually be thematic, when you want to invest. Let's get intelligent about it at the high level before even worrying about the specific names you want exposure to. But AI really, understanding just sort of that it's broad. There are just so many parts of it. This is a really good way to think about the entire just sort of landscape, right? There are those people who are, producing, again, the shovels, right, within this gold rush. There's quite a preference for them right now, and that's why NVIDIA is going up. That's why semiconductors are doing really well. But there are many other areas to look at as well. We've kind of put this together that just shows you, just sort of the different areas, and you really can play any part of it. Depending on just you saying, hey, let me learn a bit about data centers, let me learn a bit about servers, let me learn about, you can learn about them at the high level, and then, just take a view. We typically suggest doing sector ETFs rather than individual stocks when it's a high-level industry that you're thinking about. So if you wanted exposure to semiconductors, for example, you don't have to buy NVIDIA, which is one stock that can then, lead to single stock risk. You can actually buy a semiconductor ETF like SOXX, for example, is a simple one that you can buy. You can also buy the Taiwan ETF if you want. A lot of semiconductors, but a broad exposure to an entire country so that you're not also too tied to what happens to semiconductors. So again, these are three themes for us that we really love. We're looking right now at, sort of the direct beneficiaries of just sort of what's going on with AI, as well as the indirect beneficiaries. We also have companies like Accenture that could benefit from just doing AI consultancy, right? So those are also additional ways to play AI. So it's definitely, I just want to encourage everyone to know that it's not too difficult to actually have a view if you do it thematically. And so that's what we're suggesting for you, is just to sort of start to think thematically about different areas and invest in what you know. There's so many different industries, so many different sectors. Definitely doing it from that perspective could be a really good way. So given that, I'm now pretty much close to the end of my presentation. So just to summarize, right, we would suggest that, you just sort of really be global macro based. Like, try to first of all think about the overall, what's going on in the world. Have a viewpoint as to what's going on in the world. When you have a viewpoint as to what's going on in the world, it gives you confidence that you are then able to apply those views to very clear, interesting themes, right? And these themes I've already talked about to great detail, but you can pick what you're interested in. If you're interested in, let's say, for example, you're interested in the financial sector, you can actually decide, hey, do I want to look at the US financial sector right now and kind of have a view as to what's going on with their banks? You remember there was that regional banking crisis last year. What's going on there? What's going on with larger banks? Would they be a good investment? And you can learn about that space thematically. We always try to encourage an absolute return focus, which that is difficult to do for an individual. So that also tells you, okay, well, you can also consider, if you don't have time to do all of this, investing in a fund. And if you're going to invest in a fund, we would typically suggest that you look at a fund with some sort of absolute return focus. That means that they are active. Because remember, there's no point paying someone to be passive. You can be passive and you can be high level, you can be thematic, and you can say, I'm going to buy Microsoft and hold it for the next 10 years. But that's not what you want to pay someone else to do. So someone else really should be trying to ensure that they're using much more technology, which is becoming very common nowadays. They're using more technology to achieve your investment goals and have an absolute return focus. Many companies use macroeconomic factor models, cash asset timing models. There's just many different ways to try to, balance your risk and return profile. And also look for companies with very strong risk management. Risk management, these 5 things that we have here, the first 3 an individual can do. The last 2 are, what you can look for when you're looking for products, right? But detailed portfolio construction is extremely important. So when we heard Dr. Brown speak earlier, I was very impressed as to just sort of the way she structured her thinking. And that's what you want to do. You want to have a very structured approach towards building your portfolio. Why do you want to hold this much fixed income? Why do you want to hold this much equity? Why do you want to hold this much venture capital? And so on and so forth. It's really important that you have that very clearly done at the beginning. One of the things that we notice with a lot of high net worth individuals like yourselves, please believe in Nigeria, everyone here is high net worth individual. It's important for us to be aware that we sometimes are not even aware what our overall net worth is or what our current portfolio allocation is. people are often very off as to what that is. And that's really the first step. You need clarity on your portfolio. You need to know what your portfolio looks like. You need to know how much fixed income you're holding, how much equities you hold, and then be clear how much you want to hold. So that's now there's your current model portfolio and your proposed model portfolio. And that would then help you make sure that it's an optimal allocation. Then one of the things that really helps, just especially people who have attention to risk, and is one of the things that, institutions as well do, which I think women are naturally very good at doing, are like having very structured entry strategies, right? Don't put all your money in at once, right? That is something that I think, a lot of my female investors already do naturally. And it leads to better outcomes. So if, for example, you've done all your thematic work on AI and you are just loving NVIDIA, I would suggest you don't put the entire pot in NVIDIA at this time because of volatility, right? And just set your entry strategy at the beginning. Say to yourself, okay, I'm going to enter slowly over 6 months, and I'm going to put this much in every month, and just be disciplined. Whatever the price is, go in. What that's going to do is you're going to have an average cost, and it would make it less likely that you got in at a super high price, also a super low price, but at least it gives you just sort of a better entry price. And that's something that's important to do. Also good to have stop loss policies. We're starting to get into institutional level stuff. But that's also something that I find gives people some sense of control. If you say to yourself, and remember your stop loss should be reasonable. If equities, US equities have a volatility of 15 to 20%. So if that's the case, you really should not set your stop loss anything less than that. It should actually probably be more than that for certain types of stocks. So you want to actually say to yourself, all right, well, what level of loss will I just not take that I want to exit? And you set that up front. You don't set that in the middle because that can be very hard to then do. We then, as humans, we start justifying to ourselves why we're doing what we're doing. So all of these things can be done at the beginning. And then the last two risk management methods are really just things that institutions often do. And you can sort of be intelligent about asking your fund manager, just sort of, okay, what do you guys do? If they do quant modeling, try to understand what sort of quant models they use. If they use options and derivatives, try to understand those at the high level as well. And, just with putting some of these things in place, I would then be relatively confident that you would actually be able to have a relatively good initial investment strategy for US equities. I don't know if it's time to take questions now, but it's been a pleasure speaking to everyone, and I would love to hand back to our moderator, who is. But if there are any questions, I'm open to taking them. Thank you so much for having me.
All right, thank you so much, Ma. We really appreciate
Pleasure.
it. I mean, this section was very beautiful, and thank you for taking us through. So there are some questions in the chat box. I don't know if you've attended to them earlier, and I also don't know if you'd like to ask any question, just use the hand raising sign. Is there anybody who has any question?
Oh yeah, there actually some.
We have, okay. Yes, in the chat box. Would you like me to read them out?
I can see them.
Oh, okay.
So So how do you monitor and assess the risk in global equity? And what are your key considerations when advising institutional investors versus retail investors when it comes to investing in global equities? I would say I think I covered some of how we think about risk. It's really just trying to think of, you know, that idea of the way we look at um, our themes across our outlook, you know, just assessing what's going on. So when I was talking about, you know, China maturing, regulation of tech and everything, all those things are how we look at um, the global environment, which helps us then determine, you know, where the risks would be, right? So I think we've covered that somewhat. I think the last bit of just sort of key considerations when advising retail versus institutions, I think for retail investors, it's important for us to just be aware of our own shortcomings when it comes to time to do the necessary work, right? And so we all have day jobs, right? It's very difficult for us to actually do analysis and all that kind of stuff. And so one of the things I do advise retail investors to do is really just sort of buying ETFs rather than single stocks. There might be some single stocks that you absolutely love. Like I personally absolutely love Microsoft, and I would still want an allocation to Microsoft, even if I bought the S&P 500 ETF. But buying ETFs versus individual stocks is one of the most important things that I suggest for people to do, because it really already limits your risk, right? When you buy single stocks, you're taking a lot of idiosyncratic risk that maybe doesn't make sense for you to take. So extremely important for you to just think about doing things at a high level and not being too obsessed with any one individual stock. The honest truth is most individuals who invest do not make money when they don't have guidance and when they're by themselves, because we tend to make errors of judgment that are natural to people, whether men or women. So you'll see a lot of these platforms where you trade and so on. Most of those platforms make money from you trading, but to be honest, they also see that the people that have those accounts are not building wealth for themselves. They trade too much and so on. So this idea of just buying an ETF and leaving it to do its thing is really my number one advice. I would just suggest if you wanted exposure to US equities, to just buy SPY, which is the S&P 500 ETF. There's also a NASDAQ ETF. So you can even say, okay, well, I want to take a bit more risk. I like tech companies a bit more. So you can buy the NASDAQ ETF as well, you know. But to be honest, unless you really have the time, I would just suggest not just buying 2 or 3 stocks. Then you're going to be worried when one drops and then you sell at the wrong time. And so those are things that happen to everyone. So definitely just buy ETFs and know and have a long-term horizon. Buy ETFs, have a very long-term horizon. Now, for those who want to do a bit more work, because also, especially because I'm speaking to women in finance, I'm aware that it's a much more knowledgeable group who may actually be interested in learning more about what they're investing in and so on and so forth. So that's why I suggested the thematic approach. The thematic approach also means you're not doing analysis, you're not doing stock market analysis, but you're using your already existing knowledge of finance, of industries, of markets to then invest. But I'm still also recommending that you invest via ETFs at a high level. So even if you look at AI as a theme, I wouldn't suggest run to buy NVIDIA. I would suggest to buy the semiconductor ETF, for example. So those are I think those are most of the those are most of the suggestions I would give for retail. I think those are all the questions we have in the chat. But if there are any more, I can take them.
All right, yes, now those are all the questions we have in the chat box. And I particularly don't think there are any more in the chat box. And I don't know if there is anybody who wants to probably ask their question. Oh, there's one question now. So there's one question now in the chat box.
How do we get access to US equities? So when people ask me this, I just usually, I mean, there are a couple of apps in Nigeria that, I think people can use safely. I often don't like to give suggestions of apps because number one, it's a tricky time right now, and there actually have been a few companies that have shut down and so on and so forth. So it can be difficult to say any one particular app. So please take it with a grain of salt and please do your own research. But the largest one that does exist right now, I think, is the Bamboo app, which they've been around long enough, but I cannot guarantee that they will be around further. So please, everyone, just do your own research. For those who have access, just global access, because we do speak to some clients who have the ability to, maybe they have US bank accounts or UK bank accounts. For those ones, we actually recommend, platforms like Robinhood or Fidelity, or those ones we're more comfortable with just because of the counterparty risk being lower. Fidelity, Schwab, TD Waterhouse, if you have access to those. But of course, if you don't have access to those, in Nigeria, the easiest platform to use would be a Bamboo. With the caveat that this is a very difficult time for startups right now. We have seen some shutdowns in that space. We've seen people also just sort of, we've seen some people lose investment funds in platforms like, I know there've been a few platforms that has happened with. So that's one of the reasons I'm always a bit careful with doing that. The reason I often don't start, at Sankore, we don't have a platform for people to trade individually, because most of our clients actually prefer that we do it on their behalf. So we have a fund, but the entry it is a bit high because it's a 50K. So that's why, typically in presentations, I'm more likely to say, a Bamboo would be a better way for people who haven't invested in US equities before to just sort of get exposure. Because most people who start with that would probably not be doing more than, let's say, for example, you want to start with $1,000 or $5,000. So, just going into Bamboo and buying a few ETFs is a really good way to get started. And then for those who are now much more, those who feel very comfortable with it already, who have built their knowledge base through just, doing something small on Bamboo, then you can now look for funds like the type of funds we have and other firms have as well. But the easiest platforms, I believe, the easiest platforms for me to recommend are the ones outside of the country because of the counterparty risk. Yeah, so that's it. And yes, I will. I believe, Bisola, you have the slides, so please do feel free to share. And it was a great pleasure speaking to everyone.
Yes, I'll share.
Yeah.
I'll share the slide in a mail by the close of business today.
Okay.
So you get the slides. Thank you, Mom.
Oh, a pleasure. It was a great pleasure.
Right. Is there any more question? And if there's none, we're bringing this to wrap. And I'd like to call All right, before we go on, I just want to quickly respond. Zoom user, if your name is the Zoom user, can you kindly change it so that we can know what's your name, or you drop your email in the chat box and I'll send you a message on how to be a member of Women in Finance Nigeria. Also, if you have any other person here that you would like to join the Women in Finance Nigeria, okay, what I'll do is I'll also drop an email in the chat box. You can send me a message, or to make it fast, I'll send you my WhatsApp number so that you can send me a message and we can pick it up from there. Okay, happiness. Thank you. I will send you a message. All right. We're coming to the end of the webinar now, and I'll call Mrs. Bumi Awal to please share the closing remark. Please, Ma, are you there, Ma? You can unmute. Okay, you sent a mail earlier. All right, I'll send you the details for registration now. Thank you. Okay, if Mrs. Bumi Lawson is not here, can we have Dr. Ola Brown, please?
Hello, can everybody hear me? Okay, I can see some comments. So I'd just like to say a big thank you to all the Women in Finance members that joined. If you're interested in joining, there should be an email address in the chat, and we'll get membership details to you. We've learned a lot about thematic investing, particularly about world macroeconomics, about geopolitics. And I'm really, really thankful to Titi for being so generous with her time, as always. I'm really, really grateful. And look forward to perhaps having you on again to teach us about something else. And thank you to all the members of ESCO for your continuous support. Thank you to Mrs. Bumi Lawson for the leadership of the Education Committee, and obviously to our chairperson, Mrs. Toyin Sani, for continually innovating and evolving the platform for women.
Thank you, Dr. Ola Brown. Thank you very much to our speaker as well. Thank you.
Thank you, everyone. Thank you for having me. Bye.
All right, thank you, everyone. But you can check the email or my number on the chat box to reach me, and then I'll send you the necessary details to become a member of it. Thank you so much. Have a great day.
Thank you all. Thank you.